Short-term price action is often dismissed as noise. However, when we map price against the physical location of leveraged capital, we see a consistent directional pull toward concentrated areas of participant failure. To observe this mechanism in a live environment, we are isolating a 5-day window of Bitcoin trading data, beginning on July 3rd. This heat map from CoinGlass visualizes the real-time evolution of leveraged capital. It allows us to see exactly where traders are forced to exit their positions as price moves. In this specific frame, the axes are clearly defined. Price runs vertically on the y-axis, while time progresses across the x-axis. The bright yellow and green bands indicate the highest density of leveraged capital, where the market has the highest potential for forced liquidations. The data suggests that price action follows these liquidity pools. It is drawn precisely to the locations where the highest number of market participants will be forced to fail. Large institutional participants face a constant execution problem. They need to fill massive orders without moving the price so far that it negates their entry. To solve this, price is frequently moved into zones where retail and algorithmic traders are forced to exit. This is known as liquidity hunting. Entering high-density zones triggers a cascade of forced market orders, generating the massive volume larger participants need. This creates a mechanical gravitational pull. Price moves toward the high-leverage clusters because it's the only place with enough volume for large-scale execution. By identifying where these clusters are forming, we can calculate the likely direction of short-term volatility before the move begins. On July 3rd, the cycle begins with low volatility. Price consolidates between $61,000 and $62,000. As price moves sideways, traders stack directional bets outside the range. We see a thick yellow line of long liquidations forming at $60,500. 4 hours later, that line has intensified. The color shift toward bright yellow shows that the volume of leveraged capital at this specific price point is increasing over time. This accumulation is occurring on both sides. Shorts are stacking stops above the range, while longs are building a massive cluster of liquidations below it. This concentration of leveraged capital provides the volume necessary to facilitate a large-scale move. The required liquidity is now gathered in a single price range. By July 4th, price breaks out and moves upward, targeting the liquidity sitting above. Over the next 12 hours, price systemically targets the upper bands, making direct contact near 63,000. As it pierces this zone, short positions are forcibly closed. This generates automated buy orders, providing liquidity for larger sellers to enter. Once contact is made, the bands vanish. The leveraged capital at these levels is completely consumed. Large market participants use this spike in forced buying to fill their own sell orders. This cleared the upper leverage pool, satisfying the need for sell-side liquidity before reversing. On July 5th, we see an extreme split in liquidity. Large clusters of leverage are now visible at both 64,500 and 62,000, pulling the price in opposite directions. We see exhaustion at the top of the range. Momentum buyers are trapped at 63,500, just as the market prepares to move toward the larger liquidity pool below. This begins the second half of the cycle, a rapid downward move designed to capture the heavy long liquidations we saw building on July 3rd. The downward wick slices through the support structures, piercing the heavy yellow bands at 61,800 and 61,500. As the lowest band is consumed, momentum stalls. The forced liquidations of these long positions provide enough buy-side volume to stop the descent. With the target cleared, we see immediate mean reversion. Price snaps back as selling pressure evaporates. This rapid drop and recovery validates the thesis. Price targets the dense cluster, absorbs the available capital, and immediately reverts to a neutral state. By comparing the order book before and after this cascade, we can see how these events reset the market's leverage profile. This map shows the state before the move. Note the dense, multi-layered bands at 62,000 and 63,800. The market was heavily burdened with leveraged capital. After the move, price stabilizes near 62,500. The heat maps now show empty zones where those dense bands once existed. The leverage has been cleared. This dataset reveals 3 repeating phases: the accumulation of leverage, the targeted move to reach it, and the final absorption that resets the cycle. Drawing static lines on a chart is ineffective when market structure is driven by the real-time distribution of capital. Market structure is defined by this physical distribution of capital across the order book. By mapping these high-density centers, we can calculate the mathematical requirement for the market to clear these forced exits.